Could the current inflation trends be an overture to an economic recession? Welcome to a deep dive into the world of inflation and its potential implications on the economy. Inflation, as it stands today, is at 3.1%, in line with the forecasted inflation rate of 2 to 5% by the close of 2022. This data, based on the Consumer Price Index, CPI, is a key indicator of purchasing trends and price levels. Looking ahead, the expectation is for inflation to fall under the Federal Reserve's target of 2% by the end of 2024. The anticipated dip is largely due to a more stringent monetary policy and a contraction in money supply growth. But let's not overlook a critical factor here: the significant decline in money supply. The M2 money supply, to be precise, has seen a drop of 4.5% since March. This contraction signals a high likelihood of a recession within the next 1 to 2 years, and history supports this claim. Sustained contractions in money supply have consistently been precursors to recessions, and even to the Great Depression. The Federal Reserve, it appears, may have fallen behind the curve, overdoing quantitative tightening and monetary contraction. This sets the stage for a need for rapid rate cuts once the recession hits, potentially as much as 500 basis points worth historically. Interestingly, a lower inflation rate might not stimulate consumer spending or growth. A contracting money supply can also pull down nominal gross domestic product, GDP, expansion. Paired with a looming recession, this could lead to a prolonged period of stagnation unless the Federal Reserve decides to pivot its policy. Fast forward to 2025, and the risk of deflation becomes a real concern if the Federal Reserve continues with quantitative tightening, ignoring the declining money supply. This could create debt deflation risks and pose serious challenges for highly leveraged sectors. In conclusion, the Federal Reserve's questionable policy and lack of focus on the money supply risks a serious recession and increased asset market volatility over the next 1 to 2 years. This analysis provides a cautionary tale, shedding light on the potential consequences of inflation trends and the critical role of monetary policies in shaping the economic landscape.